All right, you ready?
Do it.
This is the Venture Capital Podcast, venturecapital.fm if you're looking for our website, with Peter Harris, founder, principal partner of the University Growth Fund. And today we're going to talk about, can you raise a Series A? So here's a hypothetical scenario let's approach. So it's August 15th, 2022, markets crashed, valuations have changed. Let's say I'm a startup that has raised $2 million.
Okay.
My question is how much traction does that company need roughly for, and this is your personal perspective, for them to then raise a Series A or maybe like a seed, so you have seed one, maybe seed two. The context of this podcast is I was listening to Jason Lemkin talk about companies that have raised $2 million. And from his perspective of, if you raise $2 million and you have not at least hit $1 million in annual recurring revenue in ARR, you're toast. You should not fundraise. You should pack up, bootstrap. You're sunk at that moment, unless like your growth rate might have somehow picked up significantly.
Yeah, he's probably right.
And this is for revenue-based companies.
Sure.
Would you agree with the same number as $1 million?
Yeah, probably. I think $1 million is the floor. I actually think it might be higher.
What would you like to see, or do you think?
Well, I mean, here's the thing. So generally speaking, Series A, you want to hit somewhere between 1 to 3 million ARR, right?
Okay.
And that's generally considered the level at which you're able to demonstrate product market fit. That doesn't mean you actually have achieved product market fit, right? Because you could have like one customer that generates all of that revenue or the bulk of it, right? Like we just looked at a deal, it was like that. But it may be that, assuming that you've got lots of customers and like whatever, like once you hit about 1 million, it's usually about enough traction for investors to sit up and say, okay, like there's something here, right, worth digging into a little bit more. And they've clearly like proven that there are enough people willing to spend enough money on this to solve their problem, right? So that's just like the general standard, and that's been the standard for the last, I don't know, probably about four or 5 years.
Does the current market change that standard?
Well, I don't think the market has changed that standard. I think it might have dipped a little bit lower last year when kind of markets were a little bit crazy in the private side and valuations were going through the roof. But I mean, today, like that's the standard, right? And so to his point, right, if you've raised $2 million, you've deployed it, and you haven't in the seed round, and you haven't like found your business model in the desert kind of thing, to be able to raise that Series A is really tough because a lot of investors are looking at their portfolios right now and they're saying, hey, I'm not going to put more money out to work into new deals unless it's really compelling. I'm going to save that money for follow-ons and in my own portfolio to support them. And so like, if you raised a seed round and you couldn't make it from seed to Series A, there's not a lot of money out there to like give you a second shot at getting to Series A. And that's why he's saying like, if you're not going to get a second shot, so you might as well just shut down and start something brand new and raise another see if you can raise money for that new idea.
Okay.
Right? Whether that's fair or not, that's probably true.
But if we peel back the onion, most people who've raised a $2 million seed round probably had some type of traction. What traction would you guess they had? 10K MRR, 8 to 10K MRR?
Yeah, probably.
So about 120K ARR.
Yeah.
So really, they're just saying with $2 million, you should have been able to 10X what you did.
Yep.
Not going from, this isn't necessarily going from 0 to 1 million ARR. This is going from like...
It could be, but not necessarily.
But most likely, statistically, it's probably more like 150,000 to at least 1 million to 3 million.
Yeah.
Okay.
And look, there's no question that that's really hard. But I mean, welcome to the startup game, right? Like it's really hard to build these things, and they're really risky. And so investors are going to look and be like, hey, look, nothing against you, nothing against all your hard work, but like, if you're not accelerating super fast, maybe this isn't the thing, right?
Okay.
Go find something that is.
What would be the growth rate? I mean, in my mind, the growth rate is from like a bunch of podcasts, you need to be growing at least 15 to 17% month over month or more.
Yeah, 15 to 20% month over month. But look, if you're growing 15 to 20% month over month from 100K, you'll hit that, right?
Mm-hmm.
You'll hit more than that by the time you get to your
But
Series A.
at your Series A, if you're doing $1 million to $3 million, you still want to see 15 to 20% growth month over month.
Yeah, I mean, ideally, you want to see as high a growth as you can get, right?
Right, but what's the floor? Hey, I shouldn't fundraise. Our revenue's not high enough. Our growth rate is not high enough. Versus, I've got a shot to a great shot. Because from ARR, you're saying $1 million is like your baseline. 3 million plus is a great shot if you've raised 2 million.
Yeah.
In a scenario of also just growth rate, you're saying 17 to 20 is kind of like probably the floor.
Yeah, probably.
And that's month over month.
Yeah, I mean, you probably need to be like, you probably need to be at least 100% year over year. So in that range, you're talking more like 8 to 10% month over month. But that's like the floor.
8 to 10 is the floor.
If you're not growing 100% month over or year over year, like it's gonna be really tough at that stage.
Okay.
I think 100% is like kind of the floor. I see most companies today, they'll grow from, call it 200K to upwards of like 1 to 2 million. And then from there, like 1 to 2 to like 5 to 7, 5 to 7 to like 12 to 14, right? Like,
okay.
So, I mean, it might be like 10x and then like 3x and then 100%. And then they maintain basically 100%. It might dip down a little bit, but yeah, they'll maintain that as they grow. And then once you hit about 100 million, things slow down a decent amount. You're maybe growing like 60% by then. Okay. 40 to 60%. But at that point, you can go public on those numbers.
What about do VCs back? I mean, the answer is yes, but as a general rule, are VCs backing non-revenue plays, so user-generated models?
Yes, they are.
What would they be looking for numbers there? Hey, I'm going to raise a Series A. I've raised 2 million so far. What type of growth or metrics are they looking for?
So in that case, I mean, they're really looking for users and engagement, right? And the ability to flip a revenue switch in the future.
Okay. So what would that look like? I've raised 2 million.
Like we're looking, like we just looked at a company that I think is super interesting. And their model is basically, hey, we're gonna get a bunch of users to use our product for this one thing. And it'll be kind of a Trojan horse strategy so that once we get enough of them, we'll like tack on this other product that they will be excited to use because we'll have all this data and like it'll really play nicely with the things that are important to them. And that's what we're really going to monetize, right? But for now, like they don't have millions of users, but they have thousands of users, but they're adding like thousands of users every month. And so like I look at it, for us, it ended up being too early. But I mean, they have an oversubscribed round. They're gonna close it. They're gonna do great. They've got some great VCs in there, and I think the reason for that is the VCs can see a very clear path to turning on a revenue switch, and they're seeing really strong growth in both users and engagement. So it's really going to depend on your business, right? For them, they're like B2B. Mm-hmm. So thousands of customers, potential customers is really compelling.
Are they getting 1,000 per month that are signing up right now?
Mm-hmm. Yeah. So from the time that we started looking at them to like today, they added, I think like 1,500. And that was over the course of, call it like a month and a half.
Okay.
So, or roughly a month. So yeah, they're adding about 1,000 new users per month. So, but look, if you're doing B2C, I mean, the scale is way, way bigger, right? Because B2B, you might be generating tens of thousands of dollars per customer. B2C, you might be generating tens of dollars per customer on average. So, you've got to have that order of magnitude, greater numbers of people.
Okay. Would a company do you remember Garrett G's company and Kirk Wiemitz? Hopefully I'm saying his last name. Garrett and Kirk, so we'll skip out the Wiemet part. With Scan.me, would they have been funded in today's market?
Look, I think would their exact same company get funded? No, but what were they at? Like 1 million users when they sold?
No, I don't know the metrics. I was hoping that you might have seen the numbers.
And that I would disclose them here.
Not that you'd disclose them, but you'd have an idea.
Yeah, I mean, based on the numbers that I'm familiar with,
Because back in the 2010s,
Look,
it was
I
kind of
think
growth at all costs, just get users, don't worry about monetizing. And I feel like that ship, at least temporarily, has passed.
oh, that's probably true. I think. Well, here's the thing. On the one hand, there's never been more money chasing deals. So, and there's never been more tools for people to track companies like that, right? So if you had a company like Scan that was growing really fast, and had like, a decent threshold of users, then I think, VCs would pay attention to that. And there's so much money and so many funds out there. Yeah, they probably would have gotten funded in this environment. The flip side is I think it's much more difficult now, and they wouldn't get the valuation that they would have gotten last year or the year before, maybe.
Okay.
Right. Like, I was just talking to an entrepreneur the other day, and he's had to cut his valuation like 3 times to get to a point where he could get a deal done. So it's just a tougher market, especially if you don't have the traction, and especially if you're burning a lot of money. So, I mean, that's the thing that I think is interesting about this other company that's more B2B is that their burn is basically non-existent.
Okay.
Because there's 2 guys just bootstrapping, and they don't pay themselves anything.
Okay.
So
it's a good spot to be in.
It's a good spot to be in, right?
Yep. What other metrics would you expect to see in general or outside of that that you may want to talk about for someone who's raised $2 million looking to raise a Series A?
Some other metrics to
look at.
Well, so if you want to raise a Series A, you probably want to be at, like I said, 1 to 3 million ARR. You're going to want that revenue to be pretty diversified, spread out among customers, so you don't have too much concentration.
A minimum of, like, say 10?
10. I mean, that's like 100. I mean, that's a really healthy ACV. But I would want to see more than 10. I'd want to see it really depends on the business, right? Mm-hmm. But if you're like B2B SaaS, I don't know, probably 20-ish.
20-ish, okay.
20-ish customers. You'd want to see some good renewals already in the bag, right?
Okay.
Obviously you're still new, so you don't have a ton, but you'd want to clear that threshold. This is a problem that one of the companies we're looking at has. They are growing insanely fast. They're probably growing 30% month over month, but they haven't gone through a renewal cycle yet. So a lot of VCs are looking at it and being like, hey, your growth is phenomenal. We don't know if people are going to renew, right? And so it's kind of been a struggle for them until they get some of these renewals under their belt. So that's part of it. I would be looking for, a pretty solid team with clear identification of where the holes are and what you're going to add and where and how you're going to spend that money. And, I probably need to have a pretty well fleshed out product by then as well. So, you're not having to add, look, your product's always going to evolve, so that's fine, but it shouldn't require a ton more work, right? It shouldn't be held together with duct tape and wire, mm-hmm. right? For those 20 customers. It's actually got to be a pretty solid product that can scale with them.
Okay. Well, this is great feedback, Peter. Anything else you want to add to this podcast?
Well, look, if you're an entrepreneur and you're in the situation where you raised $2 million, but you're not quite at 1 to 2, I think, having some, real personal time to figure out who you are and what this is going to look like is important. Do you keep chasing the dream? Do you cut your losses because life is short, time is valuable? You're better off starting something new. Can you get money from your insiders, right? And did you do a good job kind of picking investors at the early stages that could continue to support you to get you to that Series A round, and get you to that 1 to 2 million? Because I think the next 6 to 12 months are going to be tough. I think you're going to see a lot more down rounds, a lot of, I'm already seeing bridge rounds across the board, even for companies that are very healthy, very strong. So I anticipate that'll continue. And probably what he was saying is, even strong companies are kind of struggling. So if you're not a strong company, it's going to be real tough. So anyways, sorry to be a Debbie Downer.
This is good. This is great feedback because I think a lot of people don't hear this type of information.
Yeah.
And it's good knowing what am I looking at? Do I go for VC funding or do I just spend time looking for my next client?
Yeah. I will say always client money is more valuable than VC money.
I've also been biased that I feel like it's easier to always get another client than to raise venture funding.
Yep. But the flip side is your average client's not going to write a $10 million check.
Correct.
So it's a trade-off.
Most startups don't ever see a $10 million check.
It's true. It's true.
All right. Well, thanks, Peter. Go to venturecapital.fm if you want to subscribe. We've got Spotify, Apple Podcasts. Please leave a review. It's what helps us grow this podcast even more. So thank you so much. If you have questions, make sure you hit us up in the comments.
Thanks, everybody.
All right. See ya. Bye.